Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. All right, that was fun and exciting. So with that out of the way, welcome everybody to the pilot episode of the Wookend, Wook Capital's first social programming, and we are very excited to welcome all of you to join us this afternoon. I'm excited to have Chris Porcelli, an acquaintance from high school who we became reacquainted over the past year and a half amid this whole GameStop fun. I'm gonna have Chris share a little bit of his background in a minute here, but just gonna share a little bit of background about Wook and what we're looking to do with Wook and why we're doing this. As you know, some of you may or may not have yet checked out, we have a wookcapital.com website that we are in the midst of building, and of course we have the newsletter that I hope you enjoyed reading this morning or afternoon. And what is Wook Capital? So we are a startup. We just started this January. We're a private investment fund, and we really do believe that this new era of crowdsourcing information is something that is something that John Kim and I, John's the founder of Wook, the chief investment officer. We worked hand in hand in 2020, kind of with a lot of other folks crafting this investment thesis in GameStop at that time. And we saw firsthand the power of retail investors just out of the sheer passion and interest, putting in all these hours outside of their day jobs, digging up incremental information, scuttlebutt research, all that good stuff. And our hope is that as a byproduct of the success that we both had with our GameStop investment, that with Wook's access to capital, we obviously are first and foremost a private investment fund, but we are very much focused on driving a social community, an informational community, a philanthropic community that we can drive value for everybody. We're not looking for a penny of anyone's money. We're not selling you a product or service. Really, our hope is to foster an open social community in which everyone can learn together, get a little bit better together, and hopefully have a little fun together. So this is our first pilot, as I hope it's clear. This is a learning experience for us, and I hope for you as well a little bit. We would sincerely appreciate any feedback that you share with us after we wrap the call this afternoon. I included a link to the survey in the newsletter, which I have pinned to my Twitter profile. And again, we will definitely act on that feedback and try to incorporate that going forward. You're going to hear more from the Wook team. Our intention is to host a little bit more of a fireside type setting with myself, John, and Han. The three of us comprise the team today. Just a brief intro for them. We're going to do a more full-throated introduction of ourselves at a future Wookend. Is our intention for that to be the follow-up to this one based on the feedback we received. John worked in VC for a few years before turning to found Wook after the success of his GameStop investment. And Han spent some time in fintech startup space before joining Wook as our chief operating officer. Myself, I spent some time in corporate strategy at a Fortune 500 company, Ryder System. And yeah, we'll tell you more about ourselves in due time. But with that, I have a very special guest, as I noted, Chris Porcelli. Chris and I went to high school together, ran track together, and Chris has done some interesting stuff in the field of law and in shareholder activism. And obviously, shareholder activism dovetails with a lot that happened with GameStop both in 2020 and before. We're going to walk through that. We're going to define shareholder activism and really hope to hear some insights from Chris, having been on both sides of the fence, both as a shareholder advocate for shareholders as well as an advocate for the corporation. So, with that lead in, I'm going to let Chris tell us a little bit about both himself, his background, and talk a little bit about what shareholder activism means to him.
Yeah, thanks, Rod. So hi, everyone. And hopefully, if you guys have criticism of this after the Wookend call is over, it's not about me sounding nervous and like I don't know what I'm doing. I don't do spaces often, so this is my first time. But about me, I was a lawyer at a law firm that did a lot of activism work. We represented some of the top activists in the game. Some of my early campaigns were for Bill Ackman, Paul Halal, Mick McGuire. I worked on, Ackman's Chipotle campaign where they settled with the company. I worked on his ADP full-blown proxy fight. Paul Halal's successful campaign, which ultimately was a settlement where they replaced the CEO of CSX Corporation and added a couple of board members there. And I've really done it all on the activism side. And then after a few years doing that, I switched over to a different law firm that mostly advised companies and boards of directors when there was an activism situation at their company. While there, I did some really mega caps companies and some small companies. So I've really seen it all on both the offensive side and the defensive side. And since then, I've left the big law firm life, and I'm working in house at a company now. And that's really all you need to know about my background.
Great. So, Chris, then building on obviously the firsthand experience that you had, I know you shared with me some thoughts, but for the audience's sake, what I think people hear shareholder activism, and obviously there's a breadth of experiences listening in on this call. I'm looking at some of the images some of my friends who I've made over the past few years, and I know there's both retail investors who this past couple of years is their first experience in the market, and obviously it's been an interesting market the past couple of years, and I know that there are folks who've been around a little bit longer than that. And I see Ty Kim listening, and I appreciate him joining. So I'd love you to, in your words, talk a little bit about, what is shareholder activism? Well, I think people hear that word and they don't necessarily know what it means. I think it means a lot, but what is it?
Yeah. So at its essence, activism is a battle for control of a public company, right? In a public company, the strategy is set by the board of directors and management, right? And historically, a hostile takeover was the greatest threat, to the control of the company that the incumbent board would have. But today, hostile takeovers are still alive and well. But the greatest threat really is, activists acquiring a small stake of the company, and then they threaten to launch a proxy fight to push for change and their agenda. And a proxy fight it's kind of like a political campaign. It's a battle for like the hearts and minds of the shareholders from both the company and the activist. In a proxy fight, the activist, he's waging a campaign. He's trying to solicit votes and proxies generally in opposition to the board of directors, either for their board seats or for proposals that the activist puts forward. Typically, these will take place at the annual meeting of stockholders. So most public companies have an annual meeting every year. Delaware law, which most public companies are Delaware incorporated, Delaware law requires an annual meeting every 13 months. So pretty much an annual meeting every year. But there are exceptions. There's if the company's org docs allow it, an activist could call a special meeting of stockholders at pretty much any time, or launch a consent solicitation whereby they are seeking consents for either their nominees to be elected or their proposal to be approved. And in a proxy contest, you don't have to replace the full board. There's a difference between a short slate and a full slate. Sometimes activists will nominate a full board. Sometimes the activists will just nominate a couple directors, whether it's one person at their fund themselves, or just industry experts they think could help the board out. And sometimes also they involve shareholder proposals that could think like corporate governance changes. And occasionally an activist will conduct a withhold the vote campaign where they're saying, don't vote for this director or don't vote for this merger. The activism campaigns have a few different general themes, right? So there's M&A activism, right? Sell the company, or spin off this division, or don't do that M&A transaction. There's also balance sheet activism, which is you see that a lot with buy back shares or issue a dividend. There's operational activism, replace the CEO or other management, CFO, COO, or anything like that. Eliminate business lines or products to go or pursue new strategies, or simply just cost-cutting measures. And then finally, there's the corporate governance activism, where you want to change the board composition, make the chair of the board an independent chairman, because a lot of times companies have a joint CEO and chairman. There could be activism for shareholder rights or to remove certain takeover defenses, or if they don't like the executive comp. Those are your main types of activism. For a timeline point of view, these campaigns generally will start around 150 days from the annual meeting. A lot of companies' org docs require a nomination of directors or of a business proposal to be made 120 days before the meeting. So that's your general window when you can expect something to happen. The nomination of directors sounds like it's a simple thing. Like when I first started, you would think you're just nominating directors, just putting their names forward, but there's a lot that goes around it, where you have to follow properly the rules of the bylaws of the company. And as someone who's written nomination notices and tried to say that nomination notices weren't valid, this isn't something to be taken lightly. The better activists, they'll start their campaign with the nomination notice ready, all their director nominees lined up, and everything done well in advance of that 120-day deadline. And once the nomination is acknowledged by the company, typically the company will issue something saying, we received a nomination notice from the activist, and no action needs to be taken at this time, but we received it. So once that starts, game is on, right? The activists, they're playing offense. They're scrutinizing the company, the board, the management team, their track record, the strategy and performance of the company. And they can get kind of heated and pretty aggressive in their letters they're writing to the board. These letters, often they're filed as either a 13D amendment or a just a solicitation filing, and the company has to respond to these. So they're playing defense. They're defending their track record, their strategy, and their performance, and they're trying to counterattack. Talking about maybe the activists themselves, talking about their long-term strategy versus this activist short-term strategy. But their letters are a little more reserved because they're held to a higher standard and scrutiny by proxy advisory firms, investors, and the media. Now, when I say the fight is on, it doesn't mean once someone's nominated, we're going to the vote, right? As we just saw in Bed Bath & Beyond, there can be, and we saw in GameStop, there can be settlements being negotiated at the same time as the fight is going. So it really is important to start on a strong foot, because the settlement terms are heavily influenced by the sentiment of the shareholders and the proxy advisory firms. If a settlement is heavily in the activist favor, they probably have the support of shareholders, and probably we're going to get some sort of support from ISS and Glass Lewis, the two biggest proxy advisory firms. But sometimes, if there's a settlement, it could just be the company trying to get the activist out of the way, and the activist campaign wasn't going well. So you'll see a settlement where the activist is just, walking away, and the company's agreeing to a cost savings plan. So it doesn't have to be a huge thing. It could be something more simple, and that's really activism in general.
Well, Chris, that's a lot of great detail, and I know I probably could do with re-listening to that whole diatribe, because there's a lot of details in there. But what we're going to do, I think, to build off what you shared, because there's a lot of good examples that dovetail precisely with what you were saying across the spectrum of results, whether it's a settlement, whether it's a strategic review. And I think it's important, again, to reiterate, like you were saying, the board of directors of a company are the ones who are working with management to set, execute on, and ensure that the business's longer term strategy is being met. And I think many people oftentimes just look at stock prices and they forget there's an operating business that exists behind that stock price. And I think GameStop, of course, is a great example here. We have a lot of activism that we can walk through, and we're going to walk through over the next hour. My intention is for us to end around 5:30. My hope is the next 45 to 60 minutes we walk through the Inside Wook newsletter and the relevant shareholder activism events, and let Chris kind of provide his take on some questions that I'll pose to him. Obviously, I'm rather intimately familiar. I lived it firsthand. I was rather obsessed and had a very large GameStop investment during the entirety of the time period in question. So I hope that everybody walks away again more informed on what shareholder activism is, understands what the purpose of a board is, what the reasons why activists will take these actions, et cetera, at the end. And again, we'll welcome questions and hopefully have 15 to 30 minutes, at the end for questions before we wrap is my hope. So with that, then, if you have the Inside Wook in front of you, we're going to kind of start from really back in 2018. So talking about GameStop. As many of you may know, GameStop is a retailer who sells video game software, hardware, accessories, collectibles. They, as a company in the earlier 2000s, underwent a diversification strategy wherein they acquired retail cell phone company stores. Spring Mobile was the name of the business. And that was their intention, to diversify away from what everyone, even a decade ago, understood was a slowly dwindling physical gaming business. They knew that digital would slowly eat away at physical over time. And obviously no one knows the precise end date for physical. Maybe it's 5 years out, 10 years out. Maybe there's another console cycle or two. Obviously the current consoles have disk drives. But the company was obviously trying to diversify. And really they effed up. The Spring Mobile foray was pretty unsuccessful, and they got hit with a few unfortunate events. The CEO who had led that foray, Paul Raines, he was diagnosed with brain cancer. He did end up passing away after stepping down as CEO in early 2018. And really, we had a musical chairs at the helm of the company. So after Raines resigned, this head of international business, Mike Mahler, came in, and within 3 months, he was out the door. There was a rather abrupt departure of Mahler in May 2018. You can follow the Dallas Morning News link, and you'll see that there were a couple other executives. Tony Bartel was the COO, and Mike Hogan was the EVP of Strategic Business and Brand Development, both of which were terminated earlier in the year after Mahler's promotion. So yeah, the 800 million they spent buying those mobile stores, it became clear to some investors that was a mistake. So after this leadership carousel, after kind of seeing these dwindling operating results, Tiger Global Management sent GameStop's board of directors a letter urging that they undertake a strategic review. And I guess that leads me to my first question, Chris. When you see something like this, where there's a shareholder like Tiger, who's a renowned hedge fund. I think many who aren't even intimately familiar with the industry know of Tiger and have heard the name before. They wrote this letter urging that there be this strategic review, but that they had no intention of becoming activists. And they would simply sell their shares if they were dissatisfied with the response. So I guess I would ask you, is this a typical type of interchange? And the company did end up acting on Tiger's request and beginning the review. How often do we see those? And what is a strategic review? If you could maybe talk about those a little bit.
Yeah, of course. So one thing to keep in mind is these types of interactions happen all the time. There's so much that goes on behind the scenes, like private interactions between investors and companies that people don't ever know about. So there's a lot of times where activists will approach major companies with thoughts, with demands, and that never becomes public. The company could have hired all these advisors in the background. The activists could have hired advisors, and no one will ever know about that. This one was a little weird, though, right? Noting you have no intention to become an activist publicly is an interesting thing to say in a letter, because they're calling for change at the company. And I guess saying they'll sell their shares is sort of a threat, right? Because selling shares is ideally not a good thing, especially when stockholders know that this is coming. So I guess it's sort of a threat. You're sort of being an activist, but you're not going to go the full length. You're not going to do a proxy fight. You're not going to do anything else. So it's a little weird. And a strategic review, that's when a company's board looks at either selling either the whole company or spinning off a major asset, um, or doing something else. So a
Yep.
strategic review is a major thing, and these are called for all the time, and they're not always public. I've represented a number of companies that have been asked for strategic reviews, and that goes nowhere. So that's really it.
Yeah, and in this case, the company did move ahead and at minimum react to Tiger's letter, right, by confirming they were exploring discussions with third parties regarding a sale of the company, and as you can see in the chart that I included in the newsletter, the price kind of remained in a tight band really through the balance of 2018. And as 2018 wrapped up, there were a few rumors. I didn't include the links, but there was reporting in both Bloomberg and Reuters and Wall Street Journal along the way that both Sycamore and Apollo, two private equity shops, were potentially interested in taking GameStop private. They weren't able to consummate a deal, though. The company ended up selling off the Spring Mobile business for about what they paid. So obviously the shareholder capital destruction that was noted had occurred, and they were able to divest that business. But when in January they made that announcement, completed the sale, and concluded the process of selling the company, shareholders reacted pretty badly. The price dropped more than a quarter in one day in late January of 2019. So that seems to have peaked up some other longer term shareholders. I don't know what you call diamond hands other than holding GameStop for about a decade, like Kurt Wolf's Hestia Capital and Permit Capital did from 2012 and 2011, respectively. But after the conclusion of that strategic review, we got some more activism. We got a letter from Hestia's CIO, Kurt Wolf, who we'll come back to later, seeking a further return of capital to shareholders. Obviously, they just got the $700 million from the sale of that business. And shareholders said, look, give that money back to us in the form of buybacks as opposed to more destructive M&A. And we saw shortly thereafter Permit, less than a month later, form a group with Hestia, and both noting that now they had made GameStop the largest holding for the two funds. So, Chris, I would say, seeing something like this where you see two separate entities form a shareholder group to push for a common objective, is it typical that you see an activist campaign play out with groupings like this? And then in reaction to the cooperation agreement that they did reach with the company, what does that typically entail?
Yeah, groupings are pretty common, whether they're formally done or informally, or whether they're done at the beginning of a campaign or someone joins in later. Before beginning a campaign on a company, an activist will take a look at the stockholder base, and they'll know whether they have friendly activist investors or not, and that could change whether they're going to make a play for the company or not. So it's pretty common. And sometimes, these funds could get in trouble for that if they haven't actually formally declared their group via their 13D. So that's something that is been in more scrutiny lately. So you're seeing a lot more formal groups than informal groups that you had in the past. And a cooperation agreement, those are also known as settlement agreements or standstill agreements or stewardship framework agreements, depending on the investor and what they want it to be known as. But they're all the same thing. They typically involve the activists calling off their campaign and generally getting some sort of board representation, depending on, as I mentioned previously, the sentiment of the shareholders and the proxy advisory firms and what the success of the activist campaign was. And settlements are all very similar. They're all precedent driven, since the settlement agreement is going to be filed with the SEC by the company and the activist if they have a reportable position. And they can include, board seats, specific committee seats, or committee chairs, or chairman of the board positions, and reimbursement of expenses for the activist. So that's a pretty big thing. And then there will be standstill provisions that restrict the activist. So meaning they won't nominate directors or vote against directors or do a slew of other things. Like they won't do a books and records demand. They won't, institute litigation against the company. They won't disparage the company or any of its officers. those are the pretty typical things you'll see. So it really comes down to whether the company wants to continue their fight and the distraction from running their business, or take a take a risk that the shareholders will support them, or settle and then give the activists certain levels of control of their board and company.
Yeah, I think at this point the company didn't exactly have the strongest bargaining position given the negative perception and sentiment in the marketplace and the decline that had been occurring in the company's stock and operating performance. So they did settle right for two board seats that nominations that Hestia Permit made, and I basically put it on standstill for I think it was a year in this case. So kind of got them to shut up and go away, or at least go away for a year. And yeah, we'll get up to what happened after that year pause transpired between spring of 2019 and spring of 2020. Quite a lot happened with regard to the GameStop share price, as you may see in the chart that I included. After that plummet from 16 odd dollars a share after they concluded the strategic review without a sale of the company, the price just really kept dwindling. And we saw a few events transpire between then and when we come back to Hestia Permit in spring 2020. We saw the naming of George Sherman as CEO and appointment as both a board member and CEO. So he came in and after they had done the 2018 strategic review, there's obviously been some discussion now in the news about Boston Consulting Group. It looks like they had hired a consultancy along that way to help them implement a strategy to turn around the operating performance of the business. And George was appointed to help lead that strategy, which they ended up calling GameStop Reboot. We'll look a little at that in a minute. So while all this was happening, though, GameStop went ahead and look, this is more of a capital allocation than shareholder activism related decision, but the company made a decision to no longer pay a dividend. So obviously a cash dividend is something that a company will typically pay on a regular basis, quarterly, could be annually, could be biannually, to shareholders. And it's a return of capital to shareholders. So it's an alternative to buying back stock. There's some differences in the tax law and impact to holders on whether it's a buyback or a dividend, cash in hand versus, there being fewer shares and all else equal, assuming that the price of the shares would rise if there were a buyback. But the company had been paying a pretty hefty dividend because it was generating meaningful cash flow. But obviously the business was declining and we were getting late in the cycle and they were looking to do this turnaround. So the company said, we're gonna zero the dividend for now, which had some pretty negative repercussions. You need to think about your shareholder base. Certain funds, institutions are required to manage certain criteria for their investment decision making. So there might have been a mandate that the fund manager only owned dividend yielding stocks, and they were no longer eligible to own GameStop after they zeroed the dividend out, which could have caused some forced selling, which I do believe was happening. The price makes it seem that way after the announcement. The company also had some accounting rule changes come into play in the beginning of 2019. There were some lease accounting changes where retailers like GameStop, mall and strip mall retail stores are often leased. The company doesn't necessarily own the store, but it leases the store, and it's an operating lease, so they pay rent expense. But in 2019, those operating leases had to be put on the books as right of use assets and liabilities. So it made it look like the company's debt had ballooned in 2019, but all of those store leases were put onto the balance sheet. I think there might have been some algorithmic related impacts there of folks, just computers and also people looking at the number and seeing, oh, debt went up big, must be bad. Not necessarily digging in to understand it was more of just an accounting change. But again, the operating business was facing headwinds. So they zeroed the dividend. They had that debt that showed up. Things didn't look very good. The price declined precipitously from that January level. After after the dividend was sliced, it had another one of those. Oh, that was a painful drop for me as a shareholder at that time, watching my balance continue to dwindle away of my largest holding. And really, the price was for a moment the bleeding was staunched. The company did this Dutch auction tender offer, which was a peculiar way of returning capital to shareholders through buying back shares as opposed to simply buying back shares in the open market. The company said, we would purchase up to 12 million shares between $5.20 and $6 per share, I think it was. And then all of those shares were repurchased at the low end of the range, and the price kept dropping. I included my little personal note because I vividly remember being on vacation in Hawaii and just being blown away that the price of GameStop had fallen down to almost $3 per share. I was deciding, there's a new console cycle coming. I'm pretty sure we're going to have a catalyst to change things for the better between now and January of 2021. So I was buying some call options you see in the screenshot. It was somewhat purely fortuitous. I know Keith Gill, Roaring Kitty, DFV, however you want to refer to him. I didn't know him at the time, but I know he was buying calls similar time frame. And just I think a day after the screenshot that I shared happened, the trade was on the 15th, and I think Burry wrote the board on the 16th. Michael Burry, the Big Short. I think a lot of folks remember him for his portrayal in that movie, and he's obviously a renowned value-oriented investor. And we got another activist jumping in, right? So we had the standstill with Hestia permit in early 2019, getting 2 new directors named to the board. We had this repurchase of 12 million shares, which was, as you can see from the red line, that was the Dutch auctions that brought shares outstanding from a bit over 100 million down to a bit over 90 million. And now they still had another $237 odd million of repurchase authorization remaining, and the price was it's really incredible. The company had enough repurchase authorization, they had enough capital that they could effectively buy back 80+% of the company, compared to that 290 million market capitalization of the company the day prior to the letter. So Burry wrote this letter. And I guess, Chris, my question for you, have you seen? So I noted he was renowned for the book and the film The Big Short, and I think it was a surprise to a lot of people seeing him take this activist mantle up in GameStop. I know John, for example, had let me know that was when he first kind of got GameStop put on his radar. He saw Mike Burry write the board of GameStop this letter, and it kind of raised his eyebrow. I'm sure it raised a lot of other folks' eyebrows at the time. But when you see a situation like this, where a company could basically buy its entire float and take itself private almost, I guess A, have you ever seen anything comparable to that? And B, what might some of the implications of a situation like that be?
Yeah, you hit on some good points there. Activists will often ask for share repurchases. It's a pretty easy way for them to get a win because they're buying before the share repurchase, and that the share repurchase will significantly affect the price of the stock. So this isn't that common to see someone go this far and say you could repurchase this significant amount of your float, but you do see demands for share repurchases all the time. There's a lot of things to consider there. Delaware law prohibits a corporation from purchasing so much shares of its stock that it would cause an impairment to the capital of the company. GameStop was a little different, right? Because they had so much cash on their balance sheet at the time. But there's a lot of opportunity costs you have to think about. What else could they be doing with that stock? I mean, with that money, right? And there's other things to consider. For example, their debt provisions. I'm not particularly aware of what GameStop, if they had any debt at the time, or what their provisions were. But in a typical company, their debt holders could prohibit share repurchases. So you'll see that all the time when activists don't know that they're not allowed to do share repurchases. So that's a pretty common thing, but this level was not common. So that was very very unusual, I would say.
That was my reaction as well. So continuing on, just a time check, we're at 4:37. So I think we've got a little under an hour left, and I think we'll spend another maybe 30 minutes with me and Chris going back and forth before we open it up to some Q&A and some open discussion. But yeah, you had Burry write that letter. You had the company also unveil its new strategic plan shortly thereafter. So the company's working to improve shareholder sentiment. It's done now. Both the Dutch auction repurchase, it did effectuate share repurchases of 22.6 million shares in the third quarter after Burry's letter. So that shares outstanding number, again, going back to that chart I have, that graphic I have in the newsletter, brought the shares out down now from a little over 90 million to about 67 and change million shares outstanding, which incredibly, again, this is another one of those incredible things you really don't see. You saw that there were more shares short. Sounds impossible. I'm not going to get into the nuances of share lending, really, other than to the extent of how it impacts shareholder activism for the purposes of this conversation. But it really was just incredible, as you can see from the graphic that I included. For most of the first part of 2020, GameStop had more than 100% of its float short, which compared to the Russell 2000 was less than 10% typically. And now for S&P 500 companies, it might even be low single digits, high single digit, more typically for smaller caps like the Russell. But very unusual to see that, and especially unusual in the context of what Chris had to say about the cash on the company's books. It's not like this was a company that had any solvency issues. It obviously was facing structural and is facing some structural headwinds to the operating business, but the balance sheet, as Burry noted in his letter and in his interview with Barron's with Ty Kim, who was on a little earlier, and I think that was a fantastic interview. Really highlighted that, look, the balance sheet's not bad. Yes, the business is struggling. That's fine, but at this price, it just doesn't really make sense. And it was strange how stubbornly elevated the short interest remained in spite of the in spite of the accounting realities of the company's balance sheet. So just some commentary there. So yeah, we fast forward through the end of 2019 with those repurchases and Burry's involvement in the summer. The business continues to underperform. As I noted, it's a console cycle driven business. The company sells video game consoles, PlayStations, Xboxes, Nintendo Switches, etc. And the associated accessories and software that accompany that hardware is where they make most of their profit, especially on pre-owned. And late in the cycle, not much activity going on, not many new games coming out as the anticipation built for the new consoles to come out in November of 2020 or fall of 2020, holiday 2020. So it wasn't looking great as an operating business, but I think folks like Burry and others took a little bit longer term view, understood there would be this, but that company wasn't at risk of necessarily going under, like it seemed many in the marketplace were betting. So we come to spring of 2020 or late winter of 2020, and that cooperation agreement with Hestia Permit was coming up on its 1 year, and they weren't happy. I wasn't happy either. We saw the price go from double digits down to low single digits, and the shareholder group now reported that they own 7.5% of shares outstanding in a revised 13D. Chris obviously can elaborate on maybe what the difference is between some of these filings that we see, right? We see 13D. Later on, I don't have it in the write-up, but we saw a 13G filing from Senvest Capital Management. There's some nuances there, and I hope Chris can just elaborate on what those are. But we basically saw this company say, look, we got those two more board members with our settlement with you last year, but we're still not very happy, and we want to add a large stockholder to the board. We want to add Kurt Wolf to the board. And the company was not happy about that, was pushing back on that. And we didn't get a resolution. We didn't get a settlement. And we got to what Chris spoke about earlier. We got a full-blown proxy fight. So I guess my question then, Chris, would be, how frequent, like, I understand every situation is different, but I assume typically you don't see a full-blown proxy fight like this. It costs money, time, and energy for all parties, and it's more common for there to be, as you noted, things going on behind the scenes and settlements. So I guess there's two things going on with this particular proxy fight. How frequently do these sorts of matters escalate after there being a settlement the year prior and then coming back around? And then in this particular fight, given there were so many shares shorted of the company, there's some nuances with regards to who has the decision making rights for the company, who has the right to vote and effectuate change for the operating business, for the board of directors. Since you had these passive funds like Vanguard, BlackRock, et cetera, that were lending their shares out and made the determination that it was in their fiduciary interest to lend shares as opposed to make a decision on the company's future. So I guess talk a little bit about how the proxy process works and maybe how unusual this particular one might have been.
Yeah. So, almost always boards are pretty risk averse. So adding a shareholder representative, especially one that is an activist, is pretty risky. But so you're generally going to see the boards pushing back on a demand to add a director right away. Occasionally, as you mentioned, you'll see a quick settlement, and that's generally the case when it's like a Carl icon showing up at your door, right? Someone who's got years of history of success and the like with companies. So generally, you could see a quicker settlement with someone like that. This this one was you're not going to add someone right away off of a letter. And so proxy process is, there's this thing you'll see in proxy statements known as the record date. The record date is the date by which you have to own the shares to vote them at the annual meeting. Oftentimes, especially in a stock as volatile and heavily shorted as GameStop was at the time, there's a lot of movement of shares leading up to the meeting. And therefore, people who owned those shares as of the record date might have sold them and won't be voting them, or the shares could be lent out and might not be able to be voted depending on the mechanism. It's really important to have a good proxy solicitor. And a proxy solicitor, they're the people that, during a campaign, they have the pulse of the shareholders. They're collecting the votes for your side. They're talking to the proxy advisory firms. They're keeping a running tally on what they think the vote is. I don't know if you guys watched the show Succession, but in Succession there was a proxy fight, and right away they were like, we got to get DF King on the phone. DF King is one of the proxy solicitors in this space. They represent both activists and companies, and they're very good. So are a slew of others. But it's important to have a good proxy solicitor. It's very important. They'll be sending a tally pretty much every day. As you get closer to the meeting, they'll be sending tallies in the morning. They'll be sending tallies in the evening, and they're really important to know what the pulse of the shareholders are. And you mentioned before you wanted me to explain the difference between a 13G and a 13D and some of the other filings. So I'll just do that right now, just so people understand. Yeah. So a 13D is something you file when you cross 5% ownership of a company, and notably, you don't have to file that right away. So
I know there's some proposed rule changes going on.
Yeah, there are, but and as we've seen over the recent years, it's been a 10-day period. So you can really build up your position, and then once you cross 5%, you have 10 more days to build up your position. So a lot of times you'll see a 13D file that doesn't just say 5%. You could see, significantly higher than that. And a 13D versus a 13G, they're both required when you cross 5%, but a G is when you're passive, right? So, and a D is when you have activist plans. So that's a big difference, right? And there's a lot of concern about whether activists had activist plans at the time when they filed a G, and some people get in trouble with that. But their position could change, their opinion could change, or something could change that allows them to rightfully say it was a G at the time and now it's a D. And then you'll see an amendment or a D file that indicates that. There's another filing called a DFAN. It's a DFAN 14A. That's solicitation material. So when you have these letters being written by activists, if they don't have 5%, they could just file it on a DFAN, and then the stockholders will see it as well.
That's great color. I think there's one other one. So I know that we see now, you noted, for example, that it doesn't necessarily come out with the first 13D at 5%. Given that time delay, folks will accrue more. Cohen obviously went to 9% to start off with GameStop. He went to 9.8 with Bed Bath Beyond. What's the reason that we didn't see him exceed 10%? I know that there's a reason, but tell us, what does that 10% mark mean? What are the implications there of staying under that?
Yeah, so there's a couple, right? So once you cross 10%, you have to file a Form 3 with the SEC, and that means you're an insider technically. And then any future changes of ownership, you have to file a Form 4, right? So with a 13D, you only have to file an amendment when you move 1%. So you can make a couple incremental buys. You do have to eventually file them if they're within a certain time period, the actual buys. But if you just buy a couple shares, you don't have to file it or sell a couple shares. With once you're over 10%, you have to file a Form 4 for every transaction. And that not only does that expose you to more scrutiny, but it's also more things to worry about. And then more importantly, probably is once you're a 10% holder, you're subject to the short swing profit rules. This requires you to disgorge any profits on any trades within 6 months. So buys. So say you buy and then you sell 6 months later, less than 6 months later, you have to disgorge those profits. So you
You're
you
locked in.
really yeah. So you really don't want to be over 10%, even if like the company sells itself. You could be kind of in trouble because you have to commit to the sale and then you have to disgorge those profits. So people really don't want to cross 10%.
Yeah.
And one more thing on this topic, and we've seen it a lot, especially when COVID started. Yeah, shareholder rights plans or poison pills, they could have a trigger uh, at 10% or 15%. Generally, see more like 20%, but you don't want to cross a trigger of a shareholder rights plan because then you're just going to get diluted and it's just a waste of your money.
Yes, that definitely encourage everyone to read up a little on poison pills. I think those came about in the 80s, if I remember correctly, as they began to defend against the LBOs and the corporate raiders. But a lot of fun history about all those campaigns. Um, Barbarians at the Gates is it right? The
Yep.
book, the
Yes.
famous one.
Yes.
Um, with KKR, not to sidetrack us, but there's so much rich material out there, and again, I think hopefully you all who are listening along are finding some of this informative, some new takes, and hopefully educational to an extent. Um, so just to keep us rolling along, and Chris, thank you for the detail on the filings and on all of that. It's really helpful. So we switch up gears a little bit. We get the board vote where, as I noted, there was only 2/3 of the shares voted because of the borrow mechanism. It was. I think I'll pontificate for a moment on that point. It was really astounding as a shareholder to be following this extremely closely while it was all happening. Chris noted the record date, so shares would need to be recalled if they were on loan ahead of the record date in order for those shareholders to vote in the contest. And because of those recalls, some of which were transpiring, the borrow rate, right there's a market, it's a liquid market, whatever if there's a very high demand and very low supply. In the case of GameStop, we saw the very high level of short interest, and inherently, as shares were recalled, the supply was squeezed somewhat. So we saw the borrow rate, and it was referred to in the journal article, rising from the levels that it was at to between 80 to 190% annualized to borrow uh, the shares. So if you're a short seller and you're paying 190% annualized, now obviously that was a blip. It wasn't going to remain at that level for a durable period, but you need the company to go to zero within about 6 months to break even, assuming that the rate stayed at that point. So it just really shows you how many like weird distortions were really going on. Uh, and look, I personally opted at that time after the record date to convert some of my shares, my personal shares, uh, into a futures position, really, because as a share owner, depending on your broker, you may not be able to lend your shares and receive any of that attractive borrow fee. What I was able to do, and what may be an opportunity if you see situations like this in the market, is you could be able to buy a call option at one at say the price was $5. You could buy the $5 call option and sell the $5 put option. Now, because of kind of put call parity, again, not to go too deep into it, all of that borrow fee is effectively built into the price of the put. So assuming it was a normal security where there wasn't any lending or high borrow, a $5 same expiration call versus $5 put would be pretty much on par. So there's no arbitrage. But by selling the, say, January 2021 put for $5 strike and buying the $5 call, I actually received a large credit because of all of that borrow fee. Now, while I didn't go ahead and buy incremental call options with that borrow, I have a friend who wisely took that route, and he was able to convert that into many eight figures worth of incremental gain as a byproduct of it. So just very interesting and weird things going on with the stock. And I learned a ton about market mechanics by being very closely involved with this during the time. So just to elaborate a little bit there and share a little bit more color. Again, less activism related, but just understanding some of the weird mechanics that go on as it relates to some of these activist events. So I will pull us up. It's 4:54, so I think we'll be done with this in about 15 and can open it up for 20 or so minutes of Q&A. We bring ourselves to August of 2020, August 18th. Ryan Cohen files with RC Ventures this 9% ownership stake in GameStop, the founder of Chewy.com, who had seemingly gone into retirement and have now seemingly come out of retirement to buy shares in this dying video game retailer. So while we didn't really know what the intentions were from that first filing, there was a 13DA, an amended 13D, where he added shares. There were a couple of 13DAs. I only included the one where he went to 9.98, but he went to, I believe, 9.6 interim and before the 9.98. During this time, myself, many others, I was actively involved in Keith Gill's Roaring Kitty streams. And, there were many of us just trying to very closely monitor this. Again, our intention with Wook is to really try and see if it's repeatable, that open crowdsourcing, collaborative, just discourse driven environment where people are not trying to pump a stock. We're just trying to get to the bottom of things and understand what is reality, what is truth, what is there an opportunity for security. And I spent Monday, Wednesday, Friday on his streams from really September through his last stream in January, and it was a fantastic experience that I think informed John's thinking and my thinking about what we could potentially recreate with Wook. So just to kind of touch on that, I hope Keith's still out there doing well. But we saw what was going on. We being the retail investors who were talking about GameStop, it became more clear what was going on as Cohen filed a letter to the board in November. He really laid out his view on, what he believes is necessary for the company to regain relevance and drive that long-term shareholder value creation. He alluded to an offer of a single board seat as unsatisfactory, the implication being that we later learned the company had offered him one board seat and he spurned them. There was a little bit of that back and forth going on. The company had in October announced a strategic partnership with Microsoft, which helped the price. However, really, it was Cohen's incremental share purchases and interest in the company that seemed to improve the share price as he took a larger and larger stake. And things came almost to a head in early December. The company reported third quarter 2020 earnings. And for those of us who listened to the call, I mentioned earlier, I worked in corporate strategy and competitive intelligence for several years, and I listened to a lot of earnings calls, and I remember this one. It was the absolute worst earnings call I've listened to in my life. It was just a team that didn't sound like they had any conviction, confidence, or just they sounded like they were out of their league and this floundering. The stock price reacted as such. It fell about 20% the next day. The company had filed this at the market shelf registration for $100 million, basically giving them the ability to sell up to $100 million worth of shares, in open market transactions, which was viewed, I think, negatively. It didn't seem like they needed it. Now, granted, management was very unclear about the purpose of the shelf, but I think that degraded shareholder sentiment and confidence. I began using the "We Want Cohen" hashtag after that call. We started to get a little more. I say we, it was this kind of loose collective of folks. So let me I guess stop pontificating for a second and kind of spin a question for you, Chris. So I guess a couple. We saw RC Ventures, this brand new activist who'd never filed anything previously, who'd never taken an activist position previously. One, how would you, I guess, advise a board to react to that sort of an entrant into your stock and making waves in your stock? And then secondarily, fast forwarding to that November letter that he wrote, what could the GameStop board have potentially done differently to prevent the matter from really escalating to where it got to in December and January? And then lastly, he made those, as I noted, several amendments and incremental share buys, and obviously the letter. Are these the typical tools for an activist in this sort of a campaign? Obviously, that November letter invited engagement. And for example, I know that John, Wook CIO, reached out to Ryan on LinkedIn. He actually just went into his inbox, reached out, and they had the opportunity to have a conversation in December about Ryan's vision for the company. John at the time was a significant size shareholder. So, was it just about getting other shareholders to talk to him? What's your take, I guess?
Yeah, so we'll start with the GameStop waking up to a 13D with 9% position reported. That's scary, right? From my side, representing companies, sometimes they go into panic mode. You see that there's this huge stockholder, you don't know what to do. Good companies have some sort of crisis management plan ready for this. There's lots of advisors in the space who are willing to do this for background work, just to be in the company, ready to advise if something does escalate. So they'll have a person to go to, appointment, they'll have all of that. And also GameStop might have known that Cohen was building a position. It's hard to buy 9% of a company without, affecting the stock price or the volume and someone realizing what's going on. A lot of companies hire a stock watch firm who monitors the stock and can kind of put the pieces together that a position is being built. Cohen is, this first time it's a little different, right? I'm a cat owner. I love my cat. I love Chewy. I love Ryan Cohen. But at that point, that's really all people knew him for, So they didn't know whether he would actually go forward with the campaign. So my first rule of activism defense, and most people's first rule, is to engage with the shareholder. There's no harm that can come out of speaking with them right away and hearing their thoughts. You could already be planning to do a lot of the things that they're saying and just, can't be public about it. So you could just, quickly get into it and enter into an NDA and then say, hey, listen, we're looking for new board members. We're looking for these things you want. We're planning all of these things. So you should engage right away. And part of that is proxy fights are kind of like, theater, I guess. How does the story sound to shareholders? There's a part in the proxy statement. And just in case people aren't really clear what a proxy statement is, that's like the big filing you do that has all the information about the shareholders, the nominees, the proposals. Both the activist and the company files one. The company files one every year for their annual meeting, but it's different when it's a contested solicitation. There's all this wartime proxy language that's put in, and in a wartime proxy statement, there's this section called the background of the solicitation. That tells the full story of the campaign and the engagement between the shareholder and the company. So, when I'm representing an activist or a company, the first thing you're doing is from day one is you're building this contact log that shows all of the contact you've had with the company or with the activist and, the results of that. And that's one of the biggest things. You spend a lot of time working on that and crafting that story to tell stockholders, because it's really the first time you could really tell everything. Up until your proxy statement is filed, the company typically tries to keep everything more neutral because it's like a race to get your proxy statement filed. Because once your proxy statement is filed, you can go out and start soliciting votes. So you want to keep your filings pretty simple because the SEC is reviewing your filings and commenting on them and asking for more disclosure or, clarifying certain things. And in the background, both sides, the activist and the company, are sending letters to the SEC called poison pill letters or poison pen letters or bed bug letters that's saying everything the other side is doing wrong. So it's like all this background stuff going on, and that's really like the heart of the proxy contest. And a lot of people don't know about these bed bug letters, but they're like huge, and you're pointing out anything they did wrong. Like the lawyers on both sides, they know the rules like so well, and just like if a company's poorly advised, they could make mistakes. If the activist is rushing and doesn't have all their ducks in a row, they could make mistakes that just slow down their solicitation. So it's really important to have everything right. So Cohen, and now shifting to these amendments Cohen was doing, yeah. So
and Cohen changed lawyers too, and I know we talked about that a little bit, you and I, at the time, before we kind of get into the personal side of the story. But you were pretty familiar with the two lawyers that Cohen hired. These weren't jokesters; these were pretty serious firms that he brought on board.
Yeah. And the switch was really significant to me, right? Because he switched to Olshan Froman Wolofsky, that firm. Ryan Nabel is the partner that was on his 13D when he switched. And those guys are no joke. They do every year, they're the top of the league tables in activism. They do a lot of these. They're good. They know what they're doing. And that's a real signal of serious intent when he switched. That I remember talking to you right then, and that was when I was like, wow, this could be big. And so that was a message in and of itself. And almost every 13D amendment is a message, right? There's parts of the 13D that are pretty basic, right? Like the company, the identity of the stockholder, the amount of shares you have. But then there's this thing, item 4, which is the purpose of the transaction. And that's where you're writing like, oh, we're going to go and we're going to, we're going to try to change the management. We're going to try and change the board. So that item 4 is so important to read because different verbiage or different like words can really signal different intent. So that's something you really got to look at. And that's what you're putting in this 13 events. You're writing in item 4 what you want to do or what you think should be done. And a lot of times it is just to file that exhibit, which is your letter to either the board or stockholders. So that's the main tool there.
Yeah. Like you said, we certainly, I enlisted your assistance and I appreciated it greatly. Seeing the change in lawyer and seeing some of the phrasing in that section of the 13D, I think that piqued folks who were looking very closely's interest, like myself and John and others and Keith Gill. Look, I included it in here, and obviously you helped me craft the letter that I ended up writing to Ryan Cohen. Going back to this idea of grouping. I had been talking about GameStop on social media, starting in StockTwits in 2018. For those who don't know, I started buying GameStop in late 2017 and basically kept buying and buying and buying and buying, and my hands were bleeding. And I think eventually my cost basis was in the 6s, but it doesn't feel very good when the price is 3. But I had built some credibility with other retail investors. I reached out to a handful of people who I'd become acquainted with along the way. I talked about earlier how much John and I talked about what was going on and trying to just exhaustively figure things out. I got John's buy-in and a handful of other shareholders, and Chris, you helped me craft this letter that we wrote to Cohen, basically getting 4% of the shares outstanding, which I thought was pretty incredible if you think about it. This is a handful of retail investors. I've never professionally been a money manager until this new role and this new opportunity. And look, as I said at the onset, we think this is very novel. We're trying to do something new. We're not trying to raise capital from anybody. We're not trying to sell products or services to anybody, but we are trying to create this kind of informational, educational, social sort of community of retail investors to kind of get better together. But I guess I would ask you, when we did that, how uncommon is that? Have you ever heard of something novel like that for like a small retail collective to reach out? And it seems like we helped him convince the company in some capacity that he had the votes to get a resolution, because within a couple of weeks of the letter, we did get the settlement.
Yeah, I mean, I hadn't really ever seen something like what we did there. That letter was a little different, right? Generally, on a lot of the activist campaigns I worked on, you're going to start a website for the campaign to put all your filings, all your materials, your nominees, pictures of them, and all of that. And there'll be a spot on the website where you can send messages. So always you're getting messages from shareholders, like either support or sometimes negative, but you're often seeing messages. But something like that, where it's a group of retail shareholders, your loose collective of people that had 4% of the stock, and indicating that you're going to hold through the record date and vote your shares, is huge. It's because it's really a race to 50% of the voting stock, not 50% of the outstanding, 50% of the stock
That's
that
right.
votes.
That's right.
And yeah, so knowing that you have 4% of the outstanding stock in your back pocket and the company doesn't know, that's a huge benefit. There's been times where companies or activists knew they had a group of people that are supporting them, and it could be a meaningful group, but they're not, they're not an actual group. They're a loose collective or something. There's been times that has changed a fight. I've been on campaigns where no one knows why they're pushing through to the end, but it's because you have this 7% that really plays like 12% in your back pocket. So this was different, and I think it was important, and that's why I kind of advised you to send the letter so Cohen would know that he has this external support, and that it's not just these apes on Reddit going wild. It's actual people who understand the mechanics of the proxy process. So I think that was unique, and it was pretty important.
Yeah, it was, and it was not, it was not me reaching out to random, shareholders on Reddit. By and large, this is people I'd spent months talking to. So I felt confident there was a much larger number than that 4%. I didn't have to go very far to get to that 4%. So it seemed pretty obvious to me that he'd had the hearts and minds of retail based on the reactions I received when I acquired. Keith Gill declined my offer when I asked if he wanted to be involved. He declined, so just full disclosure there. But yeah, so that was things accelerated quite quickly from there, right? Within a few weeks, there was the settlement that was announced. There was no need for further proxy action since RC Ventures reached that settlement for 3 directors to be named to the board. We're not going to necessarily go into further detail, but we did see after the settlement, obviously there was effectively a board takeover. At this point, Cohen is the chairman. Cohen basically runs the show. He's the largest shareholder. He increased his position again, of course, a week or so ago by 100,000 shares. He owns 11.9% presently. The board has been completely revamped. There's a completely refreshed board. So like I've said in my Bloomberg interviews and other, GameStop of March 2021 was a completely different leadership team, completely different strategy than the GameStop of 2020 and prior. And it was really incredible to experience that firsthand. I hope that this has been a really informative kind of walk through that history, with me and Chris. I don't want to leave Bed Bath Beyond to the wayside. So before we open it up for questions from the audience, I'm going to kind of touch on Bed Bath Beyond briefly. So this one was interesting to me, Chris. You talked about the implications of 10%, right? And I shared a tweet. I included the link to it where I kind of did the math. Cohen is a smart guy. He's obviously a very bright person, and he's got a great team that he's working with Neville and co. Bed Bath Beyond had this share repurchase authorization that they had said that they would exhaust by the end of the fiscal 2021 year. And it was obvious when you look at Cohen's activity. If you look at my tweet, you can see the end of the fiscal year for Bed Bath Beyond was the 28th of February. And you see Ryan Cohen on the 28th, and then on the 1st, 2nd, and 3rd of March, basically complete all of his purchases after knowing that Bed Bath Beyond had to exhaust the remaining nearly $300 million in share repurchases by end of month February. So we're at this interesting stage where if you do the math and you assume what Bed Bath Beyond paid for the repurchases, Cohen is showing that he owns 9.98% of Bed Bath Beyond right now. But when they file their K, it actually, if he doesn't make any change, will be over 10% based on the shares outstanding being reduced. So I guess the question in that vein is, is that common, like seeing an activist very precisely manage management being committed. Like it's a game of chess. Management had a commitment to do X. Cohen waited for them to do X, and then he did Y, which I found very interesting, and I enjoyed digging into. Are there any interesting implications here after the K comes out? I assume he would actually be over 10% if he doesn't adjust his position. Am I correct in my understanding? I guess could you react to that?
Yeah, I mean, not really, because Cohen's already on the board, right? So he's already an insider. He's already subject to the short swing
We're talking
profit
about Bed
rules.
Bath Beyond, not
Oh, sorry,
GameStop.
sorry. Yeah. So yeah, so you do see that a lot. You see a lot of activists, strategically managing their percentage, and there's specific rules with 13Ds and filings about, whether company share repurchases or whatever push you over that percentage that requires an amendment. So you will be managing it. You'll have someone at the law firm or someone at the fund will have a calculation going
Right.
at all times. I don't know if they're specifically, and I haven't been specifically involved where they're calculating to the share, working with management to make sure they don't cross a threshold. So I'm not that sure about that. So so I can't really give that full
Sure.
of an opinion on that.
Okay, that's fine. Clearly, though, just going back to your comment about boards react differently to known commodities versus unknown commodities. Cohen at this point seemingly was more of a known commodity, and I think it was a little surprising to me to see the board settle and give him three proposed new members. To their what will become an 11-person board afterwards. So clearly his impact in markets. It remains to be seen if this is something he's going to be doing more broadly, or if these were just, the second one was an opportunistic situation he saw, to potentially create the ultimate destination for babies. But yeah, it was definitely night and day from how GameStop management seemed to treat him, right?
Yeah, definitely. Now he's someone more of a threat. I don't want to say a threat, but someone that's taken a little more seriously. And not to say you shouldn't have taken him seriously before. He built an incredible company, but he's got some more power now. He's got Olshan in his corner, and people know that he's gonna do this, and that is rich. Typically when you're negotiating a settlement, it goes down to percentage of the company, percentage of the board. But when an activist shows up and has some sort of popularity and surging of the stockholders, sometimes you refer to like a mandate from the stockholders to make a change. So you'll see all the time, you'll see stockholders get more than their percentage, a rich percentage. For example, I had mentioned the CSX campaign I had worked on, and Paul Halal and his Mantle Ridge Fund, at the time, they had only owned like 5% of the stock, less than 5%. They weren't a defiler. And they got like 40% of the board because they showed up with a CEO candidate who was, the Michael Jordan of his industry, and the stock jumped when he was there. So you do
Oh, was
see
that
a
when
lot
Hunter
of stuff.
Harrison took over CSX?
Yes.
Okay. R.I.P. But a legend.
Yes. The Michael Jordan of trains.
Yes. Wow, cool. I didn't know that one. No, but that's a great example. I mean, to own such a small stake and effectuate that much control in essence, or impact, nine in Cohen's case, obviously 9% or 10% becoming, 3 out of the 11. It's a pretty big impact and outsized impact, right? So that's crazy. It's insightful. Awesome.
Yep.
Well, look, I want to open up for some discussion, some Q&A. I really appreciate everybody for joining. And look, I want to reiterate, this is a pilot. I've never done this before. It's a learning experience for myself and the rest of the team here at Wook. And Chris, so appreciative of you joining. I think this was a great conversation. I know I learned things from listening to you, and I'm confident that a lot of the folks on the call got to learn a lot. This call was recorded. And you're welcome to listen to the replay. I'll share it. Well, it'll stay on Twitter for 30 days, and then afterwards, we'll be sure to have everything archived. As I mentioned at the onset, we're going to have follow-ups to this. We do have a survey in my pinned tweet. If you will take a look at both the Wookend newsletter and just provide feedback on how this call and how the newsletter itself was, that's the only way we're going to get better. We want this to be constructive for the community. I'm not doing this, for myself to hear myself talk. I'm doing this because I want to build with my Wook teammates this interactive community that we can kind of really just build on this novel idea that John had, that what we experienced with GameStop, really digging under the surface, crowdsourcing research, uncovering breadcrumbs. We talked about the lawyer changes, et cetera. There's so many things, the order numbers, for those of you who are familiar and remember that with GameStop.com order numbers. This is our intention. We have a very long time horizon. Our intention is to be doing this for the rest of our lives. It's a family office. It's a private investment fund. We have a very long duration, so we want to get better together over time and build a community. And again, we're not selling you anything. But with all that said, I'll shut the hell up, and I would love to welcome anybody up who'd like to ask any questions of myself or Chris, or provide any takes on what we discussed today. So I will pause for a second and let some folks request to speak if they would like to. Not all at once. Okay, I'm seeing some crickets out there. So, okay, I've got a request. Jonathan, let me add you as a speaker. Hey, Jonathan, hope you're having a good Friday. Thanks for being the first test dummy. You're on mute.
Hello, that work?
Yep, I can hear you.
Yeah, great discussion, guys. So I just had a quick question for Rod here. So after listening to this whole discussion, it's pretty clear that Ryan Cohen is, taking a positive approach to what he's doing. I don't see why. I guess you feel that it's gimmicky that he wants to do the stock split.
I'm sure, yeah.
If ultimately what he's doing is positive and he's just trying to, maximize his plan and take the best approach for his shareholders to acquire more. I just want some more insight as to why you feel that's.
Yeah.
Yeah.
We do talk a little bit about the stock split. So, I think there's been a lot of look. Twitter is not a great place for nuanced discussion, and I have a lot of nuanced views. I love talking about things with understanding that there's nuance, and there's not oftentimes very clear-cut black and white answers. From a corporate finance textbook perspective, there is a black and white answer. A stock split doesn't do anything from a increasing value of the company, right? You go from, say, having 75-ish million shares outstanding. If you slice those shares up and double them or do a 3-for-1 or whatever, the value of the company doesn't change. Now, as I kind of alluded to with what's going on of late, look, GameStop's not the only one. Google, Amazon, others have been doing stock splits. I kind of inherently view stock splits skeptically because of what I just said. They're not creating any value. Though Matt Levin wrote, and I think he's right, that in the reality of the world, there is potential for an impact of a stock split. It's lowering the barrier to entry for some who would prefer. It's a psychological barrier to entry, right? Some folks would prefer to own full shares of stock as opposed to fractional shares. While it's pretty easy for people to own fractional shares today through a variety of brokers, I understand in some countries and some brokers that's still not an option. So lowering the barrier to entry, if somebody wants to own a share of GameStop at $50 instead of $150 or what have you, I can fully appreciate that psychological barrier being lowered. And there is a functional impact as well when you think about options pricing and the hurdle for someone to buy an option, a call or put on either GameStop, Amazon, Google, et cetera. The barrier again is lower for retail. So in essence, yes, I do view it as a gimmick because it's not increasing the value of the company. But I appreciate that there can be positive byproducts, lowering the barrier to entry for an investor who has a psychological desire to own a full share or more of a stock, and maybe they only have 100 or 200, whatever. Obviously, with Amazon, we're talking very large dollar amounts. With Google, it's again a very large dollar amount. So there's that. There's that benefit. There's the access to options. So there's a few like real world potential benefits, and I would definitely recommend checking out the Matt Levin write up. I think he did an excellent job articulating it. He's a Bloomberg opinion writer. His money stuff column is, in my opinion, a must read. So that's kind of my response. Look, it's I'm not saying GameStop isn't actually doing its transformation, but when you see what I deem as more gimmicky type activity like this, it doesn't build credibility from the professional investor community, and clearly he's not necessarily targeting that, and to an extent that's okay. So I hope that's a fair response, and I appreciate the question.
Yeah, great answer. Appreciate it.
Cool. Thanks, Johnson. All right, Mr. Sick One, let me add you as a speaker. And Jacko, we'll get to you next, sir. And you're on mute.
Hey guys, sorry, when you guys transferred me over, my phone speaker went off for a second, so I didn't know that I was on. Hey, so quick question. Hey Rod, how did you know that the squeeze was squoze? Was there any specific data set that you were able to look at to say, hey, I think it's done for now, and now you're looking at the fundamentals, or how did that go? I'm just kind of curious on that. And on top of that,
sure.
I know you bought back in, and you're bullish on GameStop in the long term. What's your thesis on GameStop looking at it maybe 1, 2, 3, or 5 years from now?
Okay. So let me address the first part of the question. Look, January 2021, that week, it became a financial mania, and it wasn't just GameStop. It was a variety of securities, that are colloquially deemed the memes, right? The meme basket. But when you saw GameStop and others, being in the mouths of late night talk show hosts, the mainstream non-financial media, that plus Elon Musk tweeting GameStonk, and the share price rising by like 14 billion market cap, all of those sorts of things during that week, it was a mania, and I don't think that it's reasonable to say it wasn't. In terms of your question about knowing whether covering was happening or not, I think there's a lot of skepticism, and a lot of it's fair because of how atrociously communicated what happened was. Robinhood CEO effectively lied when he claimed they weren't facing a liquidity issue. They were. They basically were getting themselves margin called to an extent, right? By the National Securities Clearing Corp, the NSCC. It was their agreement to turn off the buy button for these securities, what have you, to lower their excess margin requirements. There was a lot of kind of the clogging of the settlement plumbing that happened at that point in time. I think people perceive that there's some hidden nefarious scheme that happened, and I don't personally subscribe to that belief. I think it really was just the system kind of getting overwhelmed by all of this capital flowing into undercapitalized brokers who made it really easy for folks to sign up for new accounts, which is great. And again, getting back to the point of us doing all this, we want to help educate and share information and have good discussions like this one with retail shareholders, because we think that what retail does is pretty damn special. These are people that out of just pure passion for investing are willing to, beyond their regular day job, spend time online in discords and chat groups and talk about all this stuff. I just, from the lens of, do I believe that meaningful share covering occurred leading up to and during that week? I do. I believe that it's entirely possible there is an underreporting of the outstanding short interest in GameStop, which doesn't mean that there's hundreds of percent of shares short. It means that maybe what's reported is underreported marginally, and that's my belief, and I could be wrong. But the existence of a short interest is a secondary at best and more so a tertiary consideration, I would say, when you're making an investment decision. So like thinking about the longer term for GameStop, to your second question, they are clearly taking pages back out of the Chewy playbook. They're going to sacrifice, and because the company was able to do 2 at the market offerings and raise meaningful capital, and now has over $1 billion of cash. They raised more than that. They burned through a little bit of it, but they've brought on, as GMATD has chronicled, hundreds of new hires, as I noted in the call. They have a completely revamped board of directors, chairman of the board, C-suite. So all of the foundational elements to enable a successful transformation, in my view, are in place. The operating business does still face real structural challenges. Physical gaming demand is only going to decline over time. It's just the reality. I personally, like, I'm playing Elden Scrolls on a PS5 disc. I prefer it. If they have physical discs, I'll keep buying them. But the mix has objectively continued to shift toward digital. And while they are seeing success in the collectibles business, I've noted that is a bright spot to look for. They took it on the chin on gross margins. They're basically funding regaining customers with both delighting them through price as well as likely promotion, and if there's, say, issues with it, right? Like Chewy's renowned for writing birthday cards, for pet owners. Obviously, GameStop's trying to embody that ethos with so much of Chewy management on both the board and on the leadership team now. So I think that they are taking a long view. Cohen is a thinker like Bezos. I'm willing to sacrifice the short-term bottom line if I can grow durably longer term. And it may not be successful. I mean, no one ever knows. Transformations are typically not successful, but I do think they have a very good chance of being successful given the opportunity set, such as NFT related gaming, blockchain related activities. I'm not by no means an expert there, but that to me is the bull case, that they are able to take share, right? They grew their Power Up paid rewards members by 30% year over year. So clearly there's still enthusiasm in the paid membership side of things. I do think they could replicate a Prime type offering for gamers. I have no idea if they will. They've been very quiet, right, as a company. So I think the strategy that they've laid out is we're going to go grow revenues and judge us off growth of revenues. But that entails them sacrificing margins in the short term. So it's going to be a long ride. Your point about 1, 3, 5 years, I have no way to know what the price is going to do. But I do think as we watch things pan out, keep looking at the top line result. Obviously, you're going to see noise in margin and also SG&A. They brought online those automated fulfillment centers in York, PA, in Reno, Nevada. They brought aboard a stateside customer service division that they didn't have previously. So look, there's a lot going on. People can see what's going on. I hope that's a reasonable response, though. I appreciate the question.
Thanks, Rod.
You're welcome. All right, so it's 5:30. I know I had said 90 minutes, but I'm going to let us run, another 10. I've got 5 folks queued up, and I want to be respectful and try to get to them all. So, Jacko, I'm going to add you as speaker and try to get through everybody. And you all can ask Chris questions too. He doesn't bite.
Yeah, I was actually just going to say, commenting on this space, that it definitely does change a person's viewpoint having these discussions. And like you guys have been saying, some of the things that you guys have been doing over the last couple of years are kind of new, sending this letter like to GameStop, and how it kind of affects, the company itself. Do truly believe I'm one of those people that in the last 2 years started finding out more about finances, just in my particular situation, but that has also even shaped my decision making in going to companies and helping, kind of direct the way that I feel like a company should even go for myself. And I just see the importance of it. So I really appreciate, one, what you guys are doing here. And I guess a question for either of you guys, seeing as you both have a pretty deep history and experience with finances and even, legislation and things, that's not something, I guess, I don't want to say not normal, but, it's not necessarily a general knowledge for, the population that we see today, that even maybe just a year ago had, there was a huge upset of clear, like that's kind of what you guys are sort of doing, not to directly take from that slogan, but it's something that does help people by and large, and kind of knowing that the opportunity is there to help people kind of gain financial literacy. Where do you guys stand as far
For
as
sure.
maybe a hit list or a foundation of knowledge to kind of get people excited? I know you guys were talking about some of these great, board fights and proxy fights and everything. And, we don't, like, for myself, being almost, 30 years old, like, I've never seen that on TV. I don't hear about that. All I hear is, GME is going down and you don't need to invest in it, or invest in this hottest stock now because ... And make a decision now. And that's not really what people in finances really do. So I guess for you guys, maybe Wook Capital has a list, Chris or yourself, Rod, have a list of, books and different things to read up on to gain that kind of understanding of behind the scenes market, or the history in which we are kind of in
this is
arena we are in today.
100%. Yeah, this is definitely the direction we want to go. Our intention is the free interchange of ideas, information, etc. Right? That's effectively the purpose of us doing this. Obviously, from a purely selfish perspective, our desire is to find insights, alpha, that come from the interchange of those ideas, those scuttlebutt research, going into stores, etc. But to your point of like resources for folks who didn't go get an MBA or a JD like Chris and I, that is 100% in our roadmap. That's something that we will gladly talk more at length about in our follow-up to this, when we kind of introduce ourselves a little bit and talk more about what we're looking to do with books. So 100%, we want to make, whether it's reading literature, whether it's references, case studies, etc., all that sort of stuff. Is to your point, a lot of the stuff that's out there, if you're just turning on the TV, I mean, just turn it off. Don't do that. It's not good. There's a lot of great literature, books that can help people appreciate, what a lot of people think is investing is really just speculating and trading. There is a difference between the two, and we absolutely want to encourage the latter, the investing. We're not, again, as I disclosed at the beginning of the call, obviously we're not offering anybody any advice, but we certainly want to provide the tools to enable what you're getting at, Jack. So thanks for the feedback. 100% more to come.
Mm-hmm. Thank you.
Thank you. All right. Unfortunately, when I see the people requesting it, it like pops people to the top of the list. And I know Kevin and Drewby, you guys asked. I just had to try Gunslinger real quick, but I'll get to you guys as well. There's 4 more folks in queue, and going to run at least 5 to 10 more minutes. So, Trigon, you're up.
Great. Hey, great to hear you guys talk, and excited to listen so far. Just a quick question on Wook Capital and the future of Wook. What type of equities and/or positions are you guys going to be investigating upon? Are we talking about just standard securities? Are you going to be looking into derivatives, cryptocurrencies, private equity at all? What's your scope?
Everything will eventually be on the board in the shorter term. Our focus would be U.S. listed equities, but look, as I got at, myself, John, on the team at Wook, we just started up in January. None of us have professionally managed money before, but we've been endowed by this, windfall, by which we're going to look to do good for the world in terms of the education that we just talked about, in terms of philanthropic work, and trying to make money off long-term investments too, and uncovering ideas. So it will be primarily U.S. equity oriented to start. I think we hope to put research out that we can be proud of and that we can get feedback on later on this year. For now, we're really just trying to get ourselves ready to scale up to do this. And as I said, really want to get feedback to understand, is this something people find valuable? Because I'm not doing this to hear myself talk, really. I'm doing this because I hope it can be building a constructive community together. So I hope that answers your question.
It does. Thanks for sharing.
Thank you. All right, Kevin, I know you've been on there for a minute. Let me add you. I'll get to Drewby next, and then Sparky and One Cubed. Hey, Kevin.
On 13Gs and 13Ds, I got a double question, basically. does it always indicate the person who submitted it is an activist, that they will be making moves towards taking control of the company or battling for control? And how important is it for these filings to be late? Like, is it a write-offable fine, or is it a major issue if it is inaccurate or like a few days late?
Yeah, good question. So a 13D filing doesn't always mean you're gonna run a proxy contest or do anything that aggressive. And also there's the reason you can file a 13G versus a D is this passive investor exemption, but you lose that exemption when you cross 20% of the company. So sometimes you'll see just major stockholders who have to file a 13D because they own 20, 21%, and that could be someone who did like a financing with the company. And then the penalties for 13Ds being late, they can be pretty severe. The accuracy, though, that depends on whether it's a material inaccuracy or not. If it's something immaterial and you just correct your mistake, you're generally going to be fine. It depends on the situation. This is very case specific. If it's a minor error and it's a small company, the SEC might not even notice it. But there is that issue where the company will probably be sending a letter to the SEC saying, "Hey, they didn't disclose X, Y, and Z, and they should have." And then you'll just see another amendment come out quickly that does disclose that. Does that answer your question?
Oh yeah, that's perfect. So just so I can make sure that I'm understanding it correctly, if company A, a person submits a 13D that is inaccurate, and then another person, say a speculator, complains about that to the SEC, the SEC reaches out to the original filer to correct that?
Yeah, there's a thing called SEC comment letters. You'll see those frequently, with public companies, just for any filing, right? A 10K could get a comment letter, but generally in this case, the SEC will issue a comment letter to either the activist or the company, whoever made the mistake. So in this case, the activist, and say, "Hey, like, we note that you said X, Y, and Z, but we think this is actually true." And then it's up to the activist to respond, and through a letter themselves. And just the comment letters, those do become public, but the bed bug letters, those are never public.
Thank you. I'm going to have to look more into bed bug letters. Is that like the term that is used that I can just Google for that and find out more?
Probably go with poison pen letters.
Thank you. If I have time, if there's time, I do have another question for both of you all.
Go for it.
So there was talk about how activism in terms of shareholders is typically battle for control of the company. With GameStop situation, we've really encountered as far as I'm aware, pretty unique situation where, as the last filing showed, 120,000+, I believe it was individual people. I'm not sure if it was accounts or people.
You're talking about the direct registration?
Yes, sorry, that. Now, this question isn't just bound by the direct registration. How could large groups like this come together and essentially submit a proposal to the board? Is there any legal way for that to happen? Since it's so unprecedented, as far as I'm aware, as a relative newbie to the stock market, it seems like a new problem to which there's no current solution.
So I'll give my take before Chris responds. I would say it seems clear management is reading various internet message boards and acting in some capacity. And in terms of a more formal, you could get several people, reach out to them. You could pen a letter to the company yourself, and say I have the support of X other shareholders or whatever, and send them a proposed item. They don't necessarily have to act on it. I assume it's less of an activist type question and more of a for the company to be informed of potential asks. But Chris, I'll let you maybe answer if you have anything else to add.
Yeah. So as I alluded to before, the bylaws of a company will have the rules to nominate directors or submit business proposals, and anyone can really do it. The general rule is you must be a record holder of shares at the time of nomination, and it has to be generally 120 days or 90 days before the meeting. But if you're just like a regular person and not a lawyer or not trained in this, there's probably going to be something wrong with your notice of nomination. Those take a very, very, very long time to do it right. I mean, I've done some in a 3-day period, and those were not good 3 days. So you can do it, but you have to be also the being a record holder is kind of an issue, right? Like, for example, if you own GameStop through like Robinhood, you're not a record holder, so you can't nominate. But if you were to put your shares into record ownership, then you can.
To clarify, I wasn't speaking as an individual so much as there are large groups that support the GameStop stock with varying views on everything. What I was questioning would be more, I mean, how web forums and polling are a thing. How do you believe it's possible for a legal organization to come together purely for the sake of gathering shareholders to create and work on proposals together in a actual interactive way before they are submitted to the board of directors? Like, I'm trying to grasp the legality of a group coming together to make such a proposal without giving up their individual stances on things. Does that make sense?
Yeah, it would be very complicated depending on the size of the group, because you have to give like all of your, every person's address would probably be required, and so much other information would be.
You really don't want that.
Yeah.
Honestly.
Yeah, so it'd be very difficult to comply with all the regulations and requirements if you're like a huge group. And as to like,
I know Chris had this conversation because we talked about it, and I think the result was there was no benefit for us to write the company at a threshold above one that would require us to file and get all of that shareholder related information. So when I wrote the letter on behalf of the 4%, obviously it was trusting that I'm not just somebody making something up as a shareholder, but there was no need for me to document any of the other shareholders when I wrote that letter to Cohen, for example. So to Chris's point, I think you do open yourself up to a lot of compliance issues, disclosure issues, if you were to try to formally represent a group more than 5%. If I have that right, Chris.
Yeah, definitely. I'd advise against it.
Yeah.
Okay. Great answer. Thank you very much for your time.
Thanks, Kevin. All right, Drewby, you're up, and I know I'm really happy to see interest, and I'm happy to see folks still hanging out listening. So I'll run this to 6 out of respect for Chris's time, and we've got 15 more minutes to hopefully get through the rest of the answers. So Drewby, you're up, and then I got Sparky and Wood Cubed on deck, and see if we have any others pop in we can get to before we wrap.
Happy Friday, guys. Thank you, Rod and Chris, for the conversation. And this, I guess this is maybe towards both of you and kind of a twofold question here. The first is, has there ever been kind of a parallel to a Ryan Cohen where they've come in as an activist and kind of remained in dark for this extended period of a time? You would figure, and Rod kind of alluded to this at one point, that, eventually down the line here, it seems like shareholders want to see there's some top line, bottom line numbers starting to increase. But then, on the other hand, you take a look at something like, AMC, and not that they're related in any fashion, but they continued to just have insiders sell shares and dilute the crap out of it. And it's continued to maintain, at a I would say a surprise level. So I guess maybe just if there's a parallel and kind of where you see or how long this could be dragged out with such a rabid investor base.
Yeah, it's probably better for me to maybe respond because I don't think there's really an activism piece for Chris to take away, but Chris, feel free to chime in if you want. Oh, look, it's very strange. It's obviously been a very strange environment in the markets. We talked about a lot of folks who are not that familiar with the ins and outs in the markets, and hopefully folks who maybe fit into that demographic will walk away from this conversation feeling more informed and maybe having some follow-up questions that they'll dig into deeper on their own. And as I said, we certainly hope that we can foster a platform for people to fulfill those learnings as we move forward with Wook. To kind of get to the essence of AMC insider selling and the price versus GameStop insider buying and the price. I mean, the price is the price. Price, as we've all seen, can really do anything in the short term. Clearly, there's retail buyers, there's institutional buyers and sellers, there's algorithmic buyers and sellers. High frequency traders who are in and out within seconds, minutes. So I don't really have a clear answer to why the stocks trade in tandem. I know there are plenty of conspiracy theories out there, and there's obviously I answered on Bloomberg some of my thoughts that you have them in this meme basket, and it's easy to trade the basket with some of the ETFs that exist. There may be derivative contracts going on behind the scenes that aren't as high level of disclosure with swaps and whatnot. But again, I don't know the answer offhand to why they trade like they do. At the end of the day, in the long run, right? Ben Graham noted it's a voting machine in the short run. In the long run, it's a weighing machine. And if AMC does strike gold, and this Hycroft mine is successful, and the cinema business recovers, is there a case that eventually that maybe could justify a price that's something close to where it trades? It's possible. Anything's possible. But yeah, same with GameStop, right? Like if you look at the current financial results, it's fair to note that on the underlying actual reported financials, the company appears on its face to be very richly valued. I don't think that's a statement most people would reasonably disagree with. I think where the disagreement would be is, do you believe the transformation has legs? Is it puffery? Is it going well? Is it not? Is the NFT opportunity real, or is it a facade? I mean, I don't have the right answer. I have my own opinion, but over time, presumably the market will get it right. But that could be years, plural. And if your duration is very short, anything can happen, good or bad. So I hope that's fair. And I don't know, Chris, if there's anything you'd add, but yeah, hopefully that answers your question, Ruby.
Yeah, thank you. You guys have a good weekend. Appreciate it.
Thanks, you too. All right, Sparky, you're up, then Wood Cubed, and then if last call for speakers after that.
You're on mute,
Sparky.
Yep. Oh, I'm sorry. I didn't realize you called on me. Hello. Thank you for your time, everyone. I'd like to know a little bit more just about your thoughts on how newer investors can deal with the psychology of investing, just the highs and the lows, maybe a little bit about managing position size. And maybe that's a topic for a future call. But I just wanted to get your thoughts.
Yeah. So that it's a great question. It really is. Managing emotions, I think John and I can talk about that. When we do this deeper dive into Wook's side of things in a subsequent call. But look, it can't give you any personalized advice, obviously, but position sizing is a hugely important thing. You read in the corporate finance textbooks the ideas of diversifying away risk by owning a basket of securities, and it's not putting your eggs all in one basket, but you have a variety of perspectives. Some people will talk about very highly concentrated portfolios. Some people will be fully passive investors, and truth be told, passive investing, if you're not going to be putting in active legwork, is the right way to go. If you're just picking stocks because you read a few things on social media, you haven't really done a lot of legwork on the underlying business and understood. There's a lot to understand about businesses beyond just the price they trade at. So I would say I can't tell you what the right thing for you is. It's very important for an investor to understand themselves, though. And I was very took it on the chin for a long time when I was heavily invested in GameStop. With hindsight, probably had gone too hard too early in buying a lot of shares in 2018 and 2019. I noted that I was meaningfully down on my position for a long period of time. So it's very uncomfortable. And you may be, if it's money that you actually don't have an investment duration for, like if it's money you need in a short period of time, you shouldn't ever be investing money you need in, less than 12, 24, whatever months. Because that's really speculating. Because as I noted, the price can really do anything in a short duration like that. And I hope that's a fair response, but 100% we plan on talking more about things like risk management, psychology, emotional, managing your emotions. Like those are hugely important. Probably the most important thing of all is understanding yourself, understanding your own personal goals and how you're going to react. And when you see a stock you own go down 50, 60, 70%, how does that make you feel? Is that going to put you at risk, et cetera, et cetera? So I don't think it's a precise answer. I hope it's a useful answer, and I hope you'll tune in next time when we talk a little bit more about it in a subsequent discussion.
It sounds great. Thanks so much. Look forward to it.
Thanks, Sparky. All right, Wood Cubed. Let's go. Last call after Wood Cubed. I've got 7 minutes till the top of the hour, and if you want to slot in behind him, great. Otherwise,
oh, sorry, I
go right
had
ahead,
a little
sir.
delay there on my end. So, looking at your investor activism and other retail activists who were really involved in the GameStop story, and looking at this new kind of internet retail activist. Kevin actually earlier kind of almost asked exactly the question I was going to ask about legal mechanisms for people to sort of have some input. I think looking at your case, you submitted a letter. Jeff Amazon submitted a letter. People really kind of stepped up and supported Cohen. But ultimately, Cohen gets the board seats. Cohen gets the control, and I've observed some discontent at times from some of the other people who participated and who don't really have any input now. And so the question is there kind of a version of what Kevin asked? Is there possibly room to look at, or a need to look at some sort of new legal form of way for people to comment on the direction of the companies that they're invested in the future?
So would you answer maybe a little bit of that, and then Chris, I don't know if you'll have anything to add to like the legal approach. I feel like we probably don't have much to add to what we responded to Kevin with, but look, I called GameStop investor relations multiple times over the years and had discussions with them after earnings calls. Like I was a tiny investor. I was, less than 0.0 whatever % shareholder, but companies investor relations, you can email them, you can reach out to them if you want to share ideas that you have with them. Obviously there's no like formal mechanism or obligation for them to implement or react to those ideas, but it's open. It should be open communication. If a company has an investor relations team, GameStop does. I assume it's still Eric Cerny. I haven't spoken to him in a couple of years at this point, but that is a mechanism by which you can, if you want to offer up recommendations or advice. But I think if it's a more structured, formal thing, that's where what Chris was saying comes into play with regards to, if you were to want to represent as a group of retail shareholders of north of 5%, then that's where the complexity gets involved, and I don't know that there's anything in the mix from an SEC standpoint to enable it to be easier for retail shareholders. Yeah, Chris, I don't know if you have anything to add.
Yeah, just one thing. Well, first off, yeah, so almost every company's press release is going to have an investor relations contact at the bottom of it. And of course, you can just Google the company and then the word investor relations and go to their investor relations page, and that there's probably a contact info there. And another thing that a lot of people don't do is there's an annual meeting of stockholders every year. If you own your stock, you can go to the annual meeting. People don't do this. Like I've been at a lot of annual meetings, and generally it's even contested meetings. It's the activist and the company. They're pretty quiet, but there's nothing prohibiting you from actually going to the meeting. If you hold the stock, they might require you to show like a license and your proof of ownership, but you can do that. That's perfectly within your right as a shareholder. It's kind of like in the movie Mr. Deeds, right? He buys one share and shows up at the shareholder meeting. That could be you.
Yeah, I know a lot of GameStop retail shareholders who actually went to the meeting last year in Grapevine. So yeah, to what Chris just said, I know people who've done it, and that's another option for sure.
Thank you.
You're welcome. Mr. Blackburn, I think you're going to round us out.
Hey, good evening, good afternoon. I guess two questions. The first one, if it's already been discussed during the meeting, I'm going to apologize. I was on a work phone call for about 20 minutes during part of the during your presentation. But I was going to ask about the GameStop stock split / dividend, which I understand about stock splits, but I'm confused on, the Reddit posts I'm seeing about the stock dividend. And then the other question was, Domo Capital's got a bunch of my money. I'm still also big member of Cash Gang. When are y'all going to start letting people, when are y'all going to start investing other people's money so I can cut y'all a check?
So to answer the second part, not anytime soon. We don't have any intention of managing other people's money anytime soon. That said, we do have it on our roadmap to prospectively have some sort of a vehicle where you can, invest in the same securities that we are, and that's talking years down the road for that. That's not a priority for us. But we're not interested in anybody managing other people's assets. We're not registered investment advisors. This is a private investment firm. So we're happy with our AUM as it is, but appreciate it. To answer your question though about the difference between a stock split and a stock dividend. So I had pulled up, and look, I have an undergrad accounting degree, but I've never worked as a CPA. I don't have my CPA, so I don't want to claim that this is 100% right. And please, dig into it yourself. But principlesofaccounting.com, which is a free online textbook. There's a chapter if you Google, stock split or stock dividend. I think it comes up pretty early, and it's corporate equity accounting, chapter 14, stock splits and stock dividends. The moral of the story is that there's some nuance on the equity side of the balance sheet equation with how the retained earnings and paid in capital and all that stuff gets shifted around, whether it's a stock split versus a stock dividend and a small stock dividend versus a large stock dividend. But the moral of the story is it's just rearranging existing equity. It doesn't change the net amount of total equity. There's not a cash dividend involved. So from I've obviously heard a lot of speculation about short sellers, right? If you're a short seller, if there's a 3-for-1 split, again, using 150 as the base, let's say, you would now be short 3 shares at 50 as opposed to short 1 share at 150. There's no recall or there's no cash outlay going on. So from the company's perspective, the stock split versus stock dividend has just some nuance on the equity side of their balance sheet equation, but it doesn't change the math. It's still cutting the pie a little bit differently. The pie stays the same size. There's some accounting nuance, but it's not something as maybe Super Stonk might desire. It's not going to trigger MOAS, if that makes sense. I hope that's a reasonable response.
I appreciate it. I mean, I certainly check Super Stonk and Reddit, semi daily.
But
it's more so for entertainment.
I think yeah, we talked about this a little bit earlier on too, so you may have missed that section. So definitely check out the replay. We talked a little bit about it. But yeah, look, it's a stock split. I mean, it's a stock dividend. It's functionally, think of it like a stock split. There's going to be, as I laid out earlier, like the benefit in the beginning of Q&A that I said was that, the price will be lower. So people may be able to buy full shares as opposed to fractional shares. That may open up the door for new buyers. It's a psychological thing. It's not a impact in the value of the company. Now, it could increase the price because of psychological reasons. I referred to the Matt Levin article about it lowering the hurdle for call option buying, so you might see an impact there. So that's my take. Hope that's helpful.
No, it totally is. And again, like I said, I respect your opinion, and your opinion hold on these things carries far more weight than potato up my ass 360 on Reddit. So
well, I appreciate that, I think. Awesome. Well, I don't see anybody else in queue, so I'm going to wrap it there. Chris, really appreciate having you on. I know like I said earlier, I definitely learned some things in this conversation. I am hopeful that the folks who tuned in learned a lot that they might not have already known about activism and some of the different nuances that go on behind the scenes that you just don't see out in the open. Really hope that people provide us some feedback on this. As I laid out, this is a pilot. We've never done this before. We're trying to make a social community with Wook, and we've got a long way to go. And this is really just setting us up for success, hopefully informed by your input. So if you'll check out the survey that I have pinned, really appreciate it. And you will hear more from us soon as we keep moving forward with our programming. So that'll wrap our first episode of the Wookend, talking about shareholder activism. This call's been recorded, so if you want to check out the replay, it'll be available for 30 days, and then I will have it accessible in the future after that on Twitter. So thanks, everybody, for joining. Thank you again, Chris, and I hope everybody has a great weekend. Cheers.